can see it for yourself in the background. The supply line stayed very offered after the close, and I'm inclined to be back in hunting for top lines into the Brent Open if this value stays in. Care regarding the dollar bears acting up as a support below, and we had to factor that into our thoughts. Now, obviously, when we started to see the bond yields moving as well, we were in good shape because obviously we were long bonds, short oil. So we had effectively what is called a double alpha trade here. And inside the world of a double alpha trade, well, we've obviously got to pay attention to ultimately how this double alpha may unfold. And obviously that double alpha trade ended up with a brilliant double alpha outcome. We had a massive upside gain on bonds and we had a massive downside gain in oil. Now, the problem you've got with that is if you get one wrong, you'll get both of them wrong and you'll end up having a scratchy type morning. If you get both of them right, you're obviously going to make your day, your week, potentially your month. And that's obviously what happened this morning. We had a massive swing sell side in oil. We said it was still short when we were having a chat about it this morning in class. We said it's still short. The net value was still about 20 ticks, 30 ticks lower, if you remember from the conversation earlier. We said it's still lower, and if it keeps going lower and the value keeps going lower, then it keeps going lower. It just kind of compounds on top of each other. And it led us to discussion about the oversimplification of layers of charting. You know, we talk about, obviously, the RSI yesterday, which had 100% winners. This morning, it's 100% losers. And we explained why that's the case. Because a very simple chart. And it wasn't so much that it's 100% losers, it's about understanding what it is. It wouldn't have been 100% losers if you traded it the way that relative value gets traded. If you traded the way the relative value gets traded, you'd have been short euro dollar. And if you were short euro dollar, the continuation drop would have been offset by the drop on the euro dollar, and you'd have ended up pretty much scratching out your spread. So you wouldn't have lost any money. But you wouldn't have made the money that you made on the short sale on the oil and the short sale on the euro that we got from that yield storyline. So we chatted about this as one of the biggest challenges, and we likened it to somebody that goes to the gym. Somebody that goes to the gym and they start seeing some gains, whether that's they start seeing the changes that they want to see, either because they're starting to build muscle, they're starting to get healthy, or they're starting to lose weight. They don't always come at the same time. So when we look at this as an idea, you've been spending a lot of time and a lot of effort, and you've achieved these results. And what happens? You stop spending the time and the effort, and all of a sudden, everything starts going backwards. The weight starts going back on. You start getting a little bit flabby around the middle. You start losing a little bit of that fitness that you'd seen to be developing. And all of a sudden, you say, this doesn't work. This going to the gym doesn't work. And then you suddenly stop yourself and recognize, or somebody else tells you, but wait a second, you used to be going to the gym 5 times a week. Now you're only going 3 times, and because you're getting disheartened, you're only going 2 times. And then all of a sudden, it's once a month. Well, no wonder the results are working their way back, because now the gains are small and they're incremental, and because they're small and incremental, the effort you're putting in doesn't seem worthwhile. Well, of course it's worthwhile. It's just that the gains that you're changing into now are incremental gains. It's smaller gains in smaller increments. Each edge is now just a millimeter different, and now a millimeter different from what you were doing before. So it doesn't suddenly become a revelation, and because it doesn't become a revelation, you don't attach as much weight to the process. And what happens? You stop using things. You stop recognizing things. You start oversimplifying things, and what happens? All the gains, all the adjustments, all the advances you've made basically vanish, and you're back to square one. And now your belief is that the process doesn't work. Well, what doesn't work is that your brain's had one of those moments where you forgot the things that you need to remind yourself of. And it happens to everybody. You forgot the things that made it successful. You forgot that going to the gym 5 times, which is hard work, you forgot that that's what made you fit. That's what made you lose weight. That's what made you build muscle, whatever it is you were trying to accomplish. You forgot that that effort was there was a reason for that effort. You forgot about how to do stuff. And that happens to everybody in every walk. So when you start going back again, you lay down your keys when you walk in the door and you go back and the keys aren't there. Well, there's only two possible outcomes, really, and that takes you into other scenarios. Two outcomes are you didn't put your keys down in the first place, or they've either been knocked off where you left them, or somebody's picked them up, or something has picked them up. Could be your cat, it could be your dog. In Kim's case, it's probably a turtle, a tortoise, an ostrich, or a llama perhaps that's got out of the pen in Kim's case. So there could be all sorts of reasons why the keys aren't there anymore. So there has to be an investigation about what else happened. And if that's assuming you've went down that road of, I definitely put the keys there, which obviously in a lot of cases turns out you definitely didn't put the keys there, but now you're too embarrassed. So when we think about the markets, we've got to remember that one line of reasoning, one line of thought, isn't actually necessarily the right line of reasoning or the right line of thought. So one of the things that we have to understand is that there's a process that comes from all of this. And that process is critical. We get it. If we look at the RSI from yesterday, remember it had 100% winners. 100% winners. So based on that RSI and based on the RGLs, you would have now been looking at this and saying to me, okay, Ray, I love this buy trade in oil. I absolutely adore this buy trade in oil. I absolutely just can't get enough of this oil. I love it. And you're looking at this massive opportunity to buy oil. And then you look at the oil chart and you suddenly recognize that all those buys have just been wiped out by the tune of several $1,000s per contract. So why didn't it work this time? It did work. It worked 100%. 100% it did work. What do you mean it worked? How could it work if you were buying oil but the oil price dropped? Because that's not what this shows. It never shows that. It's showing one side of a spread trade. That's what it shows. So what we've got to now look at is we've now got to look at this blue line, which is our dollar, and say to ourselves, dollar inverted, of course, well, is there a possibility that that's actually a sell trade? And therefore, is this not more likely to be a spread? Well, of course it's a spread. Everything we do in relative value is a spread. What we've got to do is build that extra layer of information to allow it to turn it into an outright. How do we turn it into an outright? We try and figure out, for example, on the euro dollar, what yields are doing. We knew exactly what yields were doing because we were long bonds. So we were long bonds. We know that the idea, the storyline, is the right storyline to get into. We can start recognizing the underlying condition. We can start recognizing the other stories that are part of the jigsaw puzzle. The supply line that's coming in, we can start doing the necessary work. Knowing that the euro dollar is now going to get hammered, we're in good shape, right? Knowing that euro dollar is going to get hammered on this trade, we're in good shape to now take advantage of the overall shape of the story. If yields are, if we're long bonds, you're looking at that and we're saying to ourselves, well, we need to be looking for a story here, and we got the story lining up. Everything started to give us the idea that that additional selling on the euro dollar that's coming in, that's going to drive this move now. We looked at the euro dollar first thing this morning at 7 o'clock, and we looked at the carry trade, and we looked at the index arbitrage trades, and we knew we were sell side euros. If I know I'm sell side euros, that's going to add selling pressure to oil, not buying pressure. And all of a sudden, that what looks like a buy on oil, even though the supply line was driving down at that stage, and therefore we could never be a buyer of oil regardless. But the euro might have put you off it. But when we double back and we analyze the euro, and it comes back to a conversation that I verified I was having with Paul years ago when we talked about if you're going to trade oil, you've got to know what the euro dollar is going to be doing. And Paul verified that we had that conversation several years ago. And when we recognized that we were sellers of the euro, that added to the short oil, not take away from it. Because if we know that the euro dollar seller is now going to come in and the dollar bid's now going to start coming through, we now know we have that environment to sell into. The story is now the right story. We get short bonds, long bonds, short oil. It's a double alpha trade. It's not a hedge. It's a double alpha trade. So if you wanted to hedge it, you would have been buying oil, but you would have been selling euro dollar. And as I said, that spread trade, that hedge trade, actually did okay. Oil paused for a while, and the euro dollar sold off. And we got that rotation on the euro dollar that we were obviously hoping for, that added to the sell pressure that we then got on oil. And we ended up making an absolute fortune on the short sale on oil, and we made a fortune on the short sale on the euro, and we made a fortune on the buy on bonds. And it all worked. Every piece of it worked. So in other words, what we talk about is this idea that a lot of the times in the retail space, what we found is that when people learn something new, they disregard everything else that we've taught to that point. We've had many conversations regarding this. Myself and Kim have had many conversations regarding this as well, and there's not an awful lot we can do about it. Each individual to their own, right? Everybody has their own way, everybody has their own process. But the challenge we've got is you can't forget the other stuff. It's a compound process. We build on the other stuff. We add the other stuff to the trade. We don't take it away. We build. And when we add other stuff, that makes it more complicated. It slows down the process a little bit, and your job is to keep the process quick up. Your job is to keep the process building. Your job is to compound your knowledge. And yes, it adds elements, it adds layers. But it's like anything else. To keep gaining, we've got to keep growing as traders. We've got to keep adding those small incremental edges by developing out and adding to the story, by building the story around this. And we had a great question earlier about the relationship of gold and the Forex markets, whether we can build triangular trades around gold and Forex. And that took us down a brand new road. And I was explaining as we went down this new road that one of the keys to this is not just drawing a line and then saying to yourself, well, that line that seems to make sense. Copying a line off my chart and saying, I'm going to use that. Well, but you don't know what it does. You don't know when it works and how it doesn't work. Well, you don't know how it plays. You don't understand the line. How could you possibly use it? Well, it seems to work. And what seems to work yesterday on that RSI seems to not work on the RSI today. It's not that it doesn't work. The RSI is just showing you what price is doing at the end of the day. It doesn't have any magical solutions for things. But what it shows is that the spread is there. What you've now got to do as a trader is to figure out what that spread means. The euro dollar might be massively overpriced. That might be one solution. The euro dollar was massively overpriced. 7 o'clock this morning, I was selling loads and loads and loads of euro dollars. It was massively overpriced against the carry and against everything else. And you can see that the euro dollar has had all these delta bids coming in, and the selling has kept going, and we've just made a fortune short euro dollars. So when we think about all the elements, we build our story around all these elements, yes, of course the RSI is going to work. And of course, the RSI is part of the storyline, but it's not this storyline. And it's like this gold conversation we had this morning. It's all right putting on correlations and then trading when a correlation doesn't work. But what I challenged everybody to do was to explain why a correlation doesn't work. It's not about the gold as such. It's about understanding what the correlation means. Why would it be positive? And why would it then change to negative? And if it changes to negative, what does that mean? In other words, what is driving the marketplace? Now, interestingly enough, I don't know if anybody remembers we had this conversation about gold earlier, and I suggested that there was probably going to be a trade coming up sometime soon. I suggested selling top edge bonds, for example. I says, why don't we go into the bond market and think about selling some bonds? Does anybody remember the conversation? Does anybody remember the conversation? So we obviously had a look at the dollar yen. We had a look at bonds, and I was able to work some sell side bonds. So I had a choice. I could trade either long dollar yen, remember? I could trade either long dollar yen from the conversation, or I could trade short selling treasuries. And that was the conversation. And this is the trade, because obviously the bond had just ran a sweep of the top edge stops. We had the biggest volume of the day came in. You could have bought some dollar yen. If you remember the conversation at the time, we said it's either short bonds or long dollar yen. There's the long dollar yen there. The dollar yen made money, Paul. The dollar yen made money. It went up. The bond made money. It went down. So the bond short worked and the long dollar yen worked. So it doesn't matter which one you chose. You made money on both of those two trades. So when we sold the bond off the 4s and the 5s and the 6s, it dropped down beautifully to the 23s, 24s. So that little gold class on the right-hand edge of the charts proved that I could then make a decision about selling bonds or buying dollar yen. I could make a choice. Well, they were a 50-50 choice at that stage. There was no edge to either. So you could have taken one or t'other. And you made money on both of them. Both of them. And you made good money on both of them as well. It was a brilliant little trade on the dollar. It was a brilliant little trade on bonds. And it was a live right-hand edge call. And that live right-hand edge call at 4s down to 24s isn't that shabby. Several $100s of sell-side profits makes a great trade. It's a lovely trade outcome. But it came from looking at the gold market, interestingly enough. It came from looking at the gold market. We ended up with a bond trade. And the reason why we end up with a bond trade is because we know, we understand. They're not just lines on a chart that seem to be positive or negative. There's an explanation about what's going to happen next. There's a process that we understand will probably take place, assuming that this is what the trade is and assuming this is how it's setting up. And we were right. The trade did take place, the money was made, and life was beautiful. Made a lot of cash on it. So we can see that one chart leads us to another, and then the other chart leads us to a conclusion, and then that conclusion is then placed into an auction, and that auction is either a passive exhaustion auction or it's an aggressive absorption auction. We make a choice. We join the auction. We know what trade we're looking for. We see how busy the room is, and we make a decision about how we're going to play the room. And now it's just about playing the room. The auction doesn't tell me whether I'm a buyer or a seller. The value tells me whether I'm a buyer or a seller. The auction tells me how aggressive I'm taking the trade. Do you understand? How aggressive am I taking the trade, and where am I pricing this up at? So the order flow doesn't tell me what the trade is. The order flow tells me what the auction is. And that's where I make my play. I know who's incentivized to take the price up or down. I know, therefore, what's likely to happen with the price, and I can position myself accordingly. So this is an incredibly important development. And it's obviously a very timely reminder for most people to go back through the steps to remind themselves of the drivers. It's very easy for everybody to just get a little bit lazy. Kim will remind you of her hill walking story. There was a period of time when Kim would come in and say, yes, I did the hill climb, I did the hill climb, I did the hill climb for weeks. And then there was pauses in the hill climb, and then the hill climb never happened. Why did the hill climb not happen? Was it because she never seen the results, or just because it became a little bit too much effort? It's the same as any diet. It's the same as going to the gym. It's the same as phoning your friends. It drops away, doesn't it? Well, they never phoned me, so I'm not going to phone them. I'm just going to not. And then all of a sudden, a couple of days gap of contact suddenly becomes a couple of months gap of contact. And then a couple of months gap of contact becomes a couple of years gap of contact. You form new habits of laziness, of not doing the extra. And all of a sudden, the contact's gone. All of a sudden, the relationship's broken. All of a sudden, the stuff that made things really work stops making things work. Marriage is exactly the same. I've been there. Both partners forget to do the things that made them get married in the first place. They forget the nice things. They forget the elements. A lot of people forget the elements. Now, you're lucky if they remember to buy a bouquet of flowers. Okay, being sick, buying a bouquet of flowers. I think it's a lovely thing, is a bouquet of flowers to give to somebody. And then all of a sudden, things change, and you stop remembering about stuff, and you stop remembering the small things. You stop writing things in your partner's diary so that when they open their diary the next day, there's a little message, a little note saying, love you, or I care for you, or whatever. Kim reminds you every day. Be kind to somebody. Stop forgetting to do things. Be kind to somebody, be kind to some animals, make a donation, help somebody out. So when we look at these elements in trading, it's the same storyline, isn't it? It's the same storyline. We forget about things because we haven't used them for a while. We forget about the dots plots. We forget about the measured moves. We forget about the RGLs. We forget about fast and slow. We forget about price action. We forget about, sometimes we even forget about the auction. We forget about some of the lines that are driving. We forget that every relative value is a pairs trade, and every relative value needs to do what? It needs to be assessed from the relative value side as well, not just the one side. If you're going to be professional, you've got to be successful, and you're going to be successful on a regular basis, you've got to still analyze relative value from both sides. So if I'm looking at the oil versus the euro, I've got to look at the euro versus oil as well. I've got to make sure that if that's what's stopping me selling oil, I need to figure out whether it should be stopping me selling oil or whether the euro itself is a short sell. And that enabled me to sell more oil and sell euros, and therefore double my profits, not reduce my profits. Do you see the difference? So somebody that puts in that tiny little bit of extra work doubles their profits, and somebody that forgets to do that extra bit of work doesn't take the deal because the euro's out of place. So I make double the profits and somebody doesn't make any profits. What's the difference? Same analysis, same chart. It's just that extra layer, isn't it? It's about reminding themselves of that extra layer. And that's what's important, guys. We're just coming into data here, guys. It's not much in terms of data, of course. We're just seeing the trade balance numbers from Canada and the US, so it's not the most important at this stage. 65.8, 65.5, 65.1 was forecast, so slightly bigger trade deficit for the US. Doesn't make, as I said, doesn't make an awful lot of difference on this one. Canadian trade deficit also worse than expected at minus 3.7. Anyway, so welcome in, guys. We'll go through the numbers this morning after that little chat, but it's about all education. You know, I could give you a word, and you could learn a word in a foreign language, but you may not understand the construction of the language. You may not understand the way it's phrased. You might not understand the way that the language works. And obviously, because of that, you're just learning the word. You could learn the words to a song in a foreign language, and you could sing it, but you don't understand any of the words. You're just repeating the sounds. Well, if all you're doing is following an orange line, well, that's never going to be enough, is it? You're simply following an orange line, and if it diverges, I'm trading the orange line narrative. But what is the orange line? Why might it not work? What happens if the orange line's wrong, is what I'm saying. If you're going to be consistently successful, you've got to be asking that question. What happens if the orange line is wrong? What happens if the orange man is wrong? What happens if the purple line is the wrong line to be driving today's business? What happens if there's a big data release? What the hell does the purple line have anything to do with anything at this stage? If you don't know the answer to those questions, you're bound to make mistakes. And who gets blamed for that? Myself and Kim, usually myself. Because all of a sudden, well, this doesn't work. No, what doesn't work is your brain stopped working. You stop making that a connection that there can be other drivers. And then in a relative value is never a one-sided trade. Relative value is a spread trade. If you go on the floor of the exchanges and somebody's pricing volatility, they don't price necessarily just the volatility against the underlying asset. They price volatility against the asset, the volatility curve. They price volatility against realized volatility. So they price the idea that volatility just now is at 10 and realized volatility is at 5. Well, it seems a little bit expensive in volatility terms, but obviously if it's expensive in volatility terms, what happens if the volatility is right? What happens if realized volatility is wrong? Well, realized volatility can't be wrong because it is what it is. So we know that there's a 5-point difference there. Well, is that 5-point difference tradable with a spread trade against an underlying asset? So we could maybe sell volatility, for example. If I sell volatility, I could obviously be looking at a long asset product. So I could long the S&P, I could be long the Dow Jones, I could be long the NASDAQ. So I could express that trade as a long position, but am I then seeing that the relative volatility or the implied volatility at 10 with a realized at 5 has 5 points of volatility short in it, which is long assets? But is there a reason? Can I see other things? Can I see the credit spreads narrowing, suggesting that long assets work? Can I see a rotation in the asset market suggesting that the long asset works, in which case that realized implied relationship makes sense then to the product? So it's not just the fact that volatility versus the asset is divergent. Maybe the volatility is right and the asset's wrong. It might be the volatility is right and the asset's right, but something else is wrong. So we've got to develop this layering process of knowledge. And as we develop this layering process, I know it gets busier and I know it gets more work. And you've got to take it on because that's what you're here for. It's not an entry class. We don't teach you about open, high, low, close candlesticks. We teach you about how to develop a proper professional mindset in terms of how these trades evolve and develop. Looking at the bond yield narrative, we start recognizing that maybe yields are wrong or maybe the dollar yen is wrong. We start coming up with a new scenario. At the moment, you can see quite clearly that yields are different from dollar yen, so there's a possible play here. But we're now looking at that bond as a short sell, and we're considering whether that's right. But obviously, if it's a short sell, then of course you're going to be looking at the dollar yen and you're saying, okay, well, that would assume, therefore, we agree that dollar yen is correct. Well, we need to go down a road here. We need to check that dollar yen to see if it is correct. And we looked at the gold this morning to see if we could verify that dollar yen was maybe correct or whether the gold was maybe wrong. In other words, we start a whole new scheme of investigation, a whole new level of investigation. We talked about gold being a sell side trade. Did you see what happened to that short gold, by the way, guys? We talked about gold in the classroom when we were having this conversation at lunchtime at 12 o'clock. We talked about gold being a short sale. Did you actually see what happened to the gold short sale? At 12 o'clock, this was a sale we were talking about. Remember, we were talking about gold being a sell into this higher high at 67s. It just traded 59s. It just made $800 more on that short sweep. If you took the gold short, you just made $800 more on the short sweep. So whether you took the bond short when we talked about it, or the gold short when we were talking about it, or the dollar yen long when we talked about it, you made money on all of them, every single one of them. But at least we did the necessary level of investigation to come up with the necessary conclusions that led us to every single one of those trades. We cleared our desk of any headwinds to any of those positions. And that allowed us to make the right trade at the right price, doing the right things, and obviously absolutely annihilating ultimately any one of the three markets that we were then looking at was bonds, dollar, yen, and gold. It takes that step forward. It is an extra example of a step forward. And that's what's important. That's what's important. It absolutely is, Theo. We can simplify it to a point where we simply use one line, and that could simply be a spread trade, right? If you use one line as a relative value narrative, I don't know whether the line's right or whether the price is right. You're taking a gamble, and it's a 50-50 gamble. So you've got to develop beyond that. And the only way you can make that away from a 50-50 gamble is if you trade it as a spread. In other words, if I traded the euro dollar as well as the oil, then it would be a hedge trade, right? So I would be selling oil and I'd be selling euro dollars at that stage. That type of idea is a double alpha. But if I thought the oil was a buy and the euro was a sell, well, I would obviously have to sell euros and buy oil, in which case it's a spread. It's a hedge, right? I've got probably going to lose money on one and I'll make money on the other. The idea is that the spread narrows. And obviously, if the spread narrows, I might be able to make a profit on that spread to hedge trade outcome. In other words, there's a step beyond just following a line on the screens. And that's what we've got to remember as traders. We've got to take that second step, and possibly the third step, to make sure that when we understand when we're putting our money at risk, we've covered our bases. It's not just about looking up at the big board and seeing one line changing. One line changing. It's about looking up at the big board and seeing one line changing and saying, is that going to change my storyline, or is that line wrong? And then you build a story around it. And how you build Theo's suggesting you build a story around the RGLs. Absolutely nothing wrong with that. If the RGL sell side, you're trying to build a sell side story, right? Okay, so that means that you start out with an idea, you start out with a thesis, you start out with an idea, you start out with a scenario that you're now trying to find evidence of existing. And inside that scenario, you start doing the trades that you're now wanting to do. And you start looking for only those trades, or the lack of those trades, if you like. And you build a story around fast and slow. So in oil's case, or in gold's case, it's sell side only. So I look for a slowdown in the oil price. I look for an acceleration on the sell. I look for those trades. Well, if you look at the gold, they're almost mirrors. The sells are almost mirrors of each other in terms of candlestick formation, right? Almost exact mirrors. What do we mean by almost exact mirrors of each other? Well, look at it. You know, we're talking about simplifying a process here. Well, take a look at those two, the last two gold sells. Are they almost exactly the same type of pattern? So they both come up into key price levels in the background, right? So they both came into key price patterns. There was a previous high, there was a previous high. The candle goes like this, the candle then goes like this, and the candle then goes like this, doesn't it? On 3 occasions. This occasion here, and then this occasion here, they're almost identical price action patterns. So you should be recognizing those price action patterns. You then confirm those price action patterns by the speed of the move coming away from those areas. The speed of the move coming away from those areas gives you an idea about the continuation of the short sell. So there's these elements that we can recognize builds into the processes that we're now looking for. Price action is important. We can see it. It doesn't have to be there, but it does become something that you start recognizing. It becomes something that certainly, at least it helps you with part of that investigation. And that's important to all of us. We can see processes, we can see fast and slow. We can see, for example, the speed that came off the bottom edge here and the slow reversal back into the bottom edge here is more likely to be bullish, isn't it? It's more likely to be bullish. And this puts us into a price action storyline. We understand the concept of fast and slow. We understand that one of the best BSG squeeze concepts is a candle that looks like this, a big upside candle, and then a candle that then comes away from this trade here, and a candle that maybe comes away, another candle that maybe comes away from this trade, starts pinning, and we already now know that we're probably now going to test this high, don't we? So we now know that there's a very high probability that putting a tipping price buy in there is going to make money, and it's probably now going to even extend the range at that stage. It's a price action trade. So that's what happened in this example here. We got a fast money reversal off the bottom edge. The price came down to no lower than the previous candle, started to double back on itself. And as it starts to double back on itself, we should be long off of that trade there. Price action wise, we should be long off that trade. The target price for that trade is this takeout of the high price there. Price action, the simple stuff. The marking of RGLs, the marking of the RGL levels, the fast and the slow, the increase in volume, the decrease in volume. They're all evidences, pieces of evidence that are all developing in the background, that are all visible to every single one of you. And most of you are probably just dismissing them as almost irrelevant. You haven't recognized the fast and slow. You haven't recognized the levels. You haven't recognized the wholesale prices. You forgot about the top of the hour, for example. You forgot about the top of the hour volumes. You forgot about the impact that that top of the hour volume might bring, and so on. In other words, there's a lot of stuff to remember, But your job is to try and remember it and understand it. And the way you do that is to incorporate it when we teach it, so that it becomes part of your muscle memory. When you get the habit, you're now in a new habit. And that's the difficulty when you come into fitness, is you've got to do it for several months to make sure it is now a habit. And if something changes that puts you off the habit, like COVID, for example, and everybody stops going to a gym, they've got to restart that habit, or they're going to still be there sitting doing nothing for months on end, years on end, and perhaps they'll never go back to the gym. The uptake in gym membership will collapse in those areas, right? Because the habit's been broken again, and it's very difficult to reestablish that positive, healthy habit again. But you've got to try. You've got to make that phone call. You've got to remember the things that you did that was successful the last time, and you've got to bring it back. You've got to make a purposeful effort to bring it back and begin to develop the habit again all over. It should be easier this time because you know what it is. But you've got to still recognize that you forgot about it and acknowledge that you forgot about it, and then decide to do something about it. Anyway, welcome in, guys. I hope you're all good, ready to rock and roll for today. And it's 13:40, so I'm going to grab some lunch, and then we'll get kicked off into the afternoon session. We're going to take a look at volatility today, tick versus